Hello and welcome to Bank Bazaar. In the previous part of this video, we discussed what are ESOPs, how do they work, and what are the benefits of ESOP. As promised, in this video, we'll talk about the tax implications that ESOPs attract. So let's get started. ESOPs come with dual tax implications in India, both when the employees buys the share and when they sell them. First situation, we will see what happens when the employee buys the share. When buying the shares, employees are taxed on the difference between the fair market value and the exercise price. And the tax rate applicable is based on the tax slab the employee fall in. Let's take an example to understand this. Let's assume you have 1000 shares exercised and your exercise date is 1st January 2024 and the fair market value per share is Rs 150 and exercise price is 85 rupees per share. Then your taxable perquisite will be 65 rupees per share, that is 65,000. And assuming you fall into 30% tax bracket, the tax which will be levied will be Rs 19,500. This tax will be payable in the financial year 2023-24. However, for startup employees, the government provides some relaxation. In this case, you may not have to pay the tax on the perquisite in the year you exercise the ESOPs. Instead, the TDS is deferred to one of the specific dates, whichever comes first. Number 1. Completion of 5 years from the ESOP grant date. Number 2. Date when the employee sells the shares. Number 3. Date of leaving the company. This deferral can provide significant benefit to the startup employees. Now let's see what happens when employee sells the shares. We will now continue with the same example. Suppose you have acquired those 1000 shares which were exercised on 1st January 2024 at a fair market value of 150 rupees per share. In the case 1, when you decide to sell these shares on 1st October 2024, the FMV on that date is Rs 160 per share. That means the difference between both the FMV is Rs 10 per share. So that makes your short-term capital gain Rs 10,000. Since the short-term capital gains are taxed at 15%, your taxable amount will be 1500 rupees. Now let's see what if you decide to sell these shares after 12 months. In this case, if you decide to sell the shares on 2nd of February 2025 and the FMV is Rs 180 per share, then the difference between both the FMVs, that is Rs 30 per share, will be taxable in your hands. That makes your long-term capital gains as 30,000 rupees. And the best part here is the long-term capital gains under 1 lakh rupees are exempt. Now the last part, what happens to the ESOPs when the company goes public? For unlisted companies, selling ESOPs can be a challenge. But once the company goes public, it is very easy for employees to cash out their benefit. And the fair market value is decided by the market movements. So there you have it. It is very crucial to remember the tax implications when you buy or sell the ESOPs. If you like this video, do share it with your friends and family. And do not forget to subscribe to our channel. Thank you so much for watching.